Difference between option buyer and option seller. The difference between an option buyer and an option seller, also known as a writer, is that the buyer has the right, but not the obligation, to buy or sell an underlying asset at a specified price within a specific time period, while the seller has the obligation to sell or buy the underlying asset if the option buyer chooses to exercise their option. Option buyer. An option buyer pays a premium to the option seller for the right to buy or sell an underlying asset at a predetermined price, known as the strike price. The buyer has the option to either exercise the option or let it expire worthless. The buyer has the potential to earn a profit if the market price of the underlying asset moves in their favor, but their losses are limited to the premium paid for the option. Importance of option buyer. Risk management. Option buyers can use options as a form of insurance against potential losses in the underlying asset. For example, if an investor owns shares of a stock and is concerned about a potential price drop, they could purchase a put option that would allow them to sell the stock at a specific price, protecting them against any further downside risk. Flexibility. Option buyers have the flexibility to choose whether or not to exercise the option, depending on market conditions and their own investment goals. This allows them to adapt to changing market conditions and manage risk accordingly. Profit potential. Option buyers can also use options as a way to profit from market movements. For example, a call option allows the buyer to purchase an underlying asset at a specified price, which can be beneficial if the price of the asset increases. Additionally, options can be used to create complex trading strategies that can generate profits in a variety of market conditions. An option seller or writer receives the premium paid by the option buyer in exchange for taking on the obligation to sell or buy the underlying asset. If the option buyer chooses to exercise their option, the seller is exposed to unlimited potential losses if the market price of the underlying asset moves against them, but their potential profits are limited to the premium received for the option. In summary, the main difference between an option buyer and an option seller is that the buyer has the right to choose whether to exercise their option, while the seller has the obligation to fulfill the terms of the option contract if the buyer chooses to exercise their option. Liquidity provision. Option sellers are a key source of liquidity in options markets, as they are willing to buy and sell options on a regular basis. This helps to ensure that there is always someone willing to take the other side of a trade, which is essential for a well-functioning market. Risk management. Option sellers assume risk by selling options, but they also have the ability to manage that risk through various hedging strategies. This can help to stabilize markets and prevent large price swings. Income generation. Selling options can provide a source of income for traders and investors. This can be especially useful in low interest rate environments, where other sources of yield may be limited. Price discovery. Option prices reflect the market's expectations about the future price of the underlying asset. Option sellers contribute to this process by providing their own estimates of the probability of different outcomes, which helps to establish a fair market price for the option.